Hey everyone, we are live. We are live. We are live. Let me just check my settings real quick. Let me see which mic I'm using. All right, let me change the mic over. Boom, that should sound a little better. Don't need to be using my laptop mic or my MacBook mic. I want to use this one. All right, so I hope you all are doing well. Just tapping in, wanted to give a quick update on the markets and everything, just kind of what I'm looking at for the markets and stuff. Want to give you a couple of my stock picks as well of what stocks I've been accumulating lately, and why. So yeah, we're gonna dive into it. So let's go ahead and kick the intro real quick, and we'll be right back.
Think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. So if you're on a trajectory or on the path of not being financially free, I want to help provide education so that you are on the path to be financially free. So we're going to talk a little bit about just what's happening in the markets. It kind of seems like we're in this breakdown, but then some people are saying that we're probably going to pop, and so want to just look at some some charts and some stocks and kind of just give you my perspective on what's happening right now. And so we know that the Fed has come out and they've paused rates. They continue to remain hawkish. We had CPI inflation rise up, and then we had um, um, I think it's core inflation (PCE) um, that actually slowed down a little bit. I think it was just 0.1% year over year or something like that, or month over month. And that's the one that the Fed uses to gauge their success or whatnot. Um, we did have an interesting article come out about the Bank of America CEO coming out and saying that the Fed has won a near-term battle of inflation. So now we just got to ask the question, are they correct? Right? Do we think the Fed beat inflation? So we're going to go ahead and jump over to this article really quick, see what the CEO of Bank of America has to say. All right, so Brian Moynihan, um, pretty much he says the Federal Reserve has won the near-term battle against inflation, but interest rates are likely to stay higher for longer. Bank of America's CEO Brian said on Wednesday, while consumer spending growth has slowed from a year earlier, the economy is headed toward a soft landing in which it avoids a recession. So he's in the soft landing camp, and he believes that the Fed has um, beat inflation in the near term. In the Fed's latest forecast, officials continue to pencil in one more rate hike for this year and said they expect rates to be higher for longer given a stronger than expected economy. They are winning the fight right now against inflation. They caught up fast, but now they've got equal opposite problem to be careful that they don't go too far in restricting economic activity. All right, so he believes that they're winning the fight so far. Obviously, we have the supply demand dynamics of energy, food, you name it, commodities and such. And the Fed cannot create more supply, so obviously they can only limit demand, and that is going to be temporary, right? I mean, you have your core things that people need, such as housing, food. I mean, energy, all of that, right? And so, you have to ask the question, like, okay, well, how long will they be able to decrease demand for? And so we're going to jump into just how interest rates impact markets. I want to share this with you all because it's just important that we understand this. So first, we're going to start with this section. This is from Investopedia. The effect of interest rates on inflation and recessions. Whenever interest rates are rising or falling, you commonly hear the federal funds rate. That's the rate that the banks use to lend each other's money. The banks charge higher than the federal funds rate whenever they're lending to you. So hence the federal funds rate is at 5.25 or 5.5 or something of that nature. And mortgage rates are at 7.5, close to 8%. So they're charging 2.5 to 3% over the federal funds rate. So the federal funds rate is what the banks use to lend money to each other, and they charge us a higher interest rate. And then you also have fractional reserve lending, which means that our deposits are only the banks have to keep, I think, 10% or something of our deposits on hand, and they can loan the rest out and earn interest on the rest of our money. So that's another story, but just wanted to throw that in there. It could change daily, and because the rates movement affects all other loan rates, it is used as an indicator to show whether interest rates are rising or falling. These changes can affect both inflation and recessions. Inflation refers to the rise of the price of goods and services over time. It is a result of a strong, healthy economy. However, if inflation is left unchecked, it can lead to a significant loss of purchasing power, which I'm pretty sure many of you, including myself, have experienced a loss in purchasing power. And I mean, the things that we used to buy that were cheaper, pre-pandemic, are now more expensive. Feels like our dollar isn't getting as far as it should be. Feels like it's hard to get ahead. And everything. What's going on, Cito? Good to see you. Appreciate you joining in today. So our dollar is not getting as much as it used to. So pretty much that's the loss of purchasing power. To help keep inflation manageable, the Fed watches inflation indicators such as consumer price index and the producer price index. When these indicators start to rise more than 2 to 3% a year, the Fed will raise funds rate to keep rising prices under control. So that's pretty much how the Fed tends to fight inflation. The issue that we're having with inflation now, which I've mentioned multiple times on the channel, is that the Fed can only affect demand. They cannot impact supply. So when you have Saudi Arabia, Russia cutting oil exports, that means that the price of oil is going to stay elevated, right? Because there's a lack of supply, and we aren't producing a whole lot as ourselves. Our rig counts are going down and things of that nature. Our inventories are low, the lowest since the 1980s. So that's pretty much the dynamic we're experiencing here, because the supply side of things is still pretty tight. How interest rates affect the U.S. stock and bond markets. So for stocks, when interest rate rise, it also makes it more expensive for companies to raise capital. They would have to pay higher interest rates on the bonds they issue, for example, making it more costly to raise capital. Could put a damper on future growth prospects as well as near-term earnings. The result could be a revision downward in profit expectations going forward as rates increase. So that's how it affects stocks. So a lot of stocks, they have to go out, raise capital, they have to borrow, all these things, and they have to borrow at more expensive rates, which impact their future growth. If the company is seen cutting back on its growth or is less profitable, either through higher debt expenses, right, or less revenue, the estimated amount of future cash flows will drop. All else being equal, this will lower the price of the company's stock. So you're seeing there's still a lot of stocks that are pretty cheap right now, that are less expensive than they were before, and you're seeing that their cash flows are being impacted because of the higher rates, and when they have to refinance any type of loans or mortgages or whatever, right? They have to that impacts their future income. If enough companies experience declines in their stock prices, the whole market or key indexes, many people equate with the market, the Dow, S&P, etc., will go down with the lower expectation of growth and future cash flows of a company. Investors will not get as much growth from a stock price appreciation. So that's how the rates impact the stocks, right? I think you'll get it at this point. So whenever the rates are impacting the stocks, that means that you can get them cheaper, right? So that's what I'm saying. Like rates have been going up for over a year. I think the Fed started raising rates. They announced it in 2020, late 2021, fall 2021. They really started aggressively raising rates in 2022, and now we're starting to see like, okay, this is impacting companies, but certain companies are not as impacted as others. And so we're going to look at another article really quick. And this is what could break the markets, what could break under higher for longer interest rates. So this is the Fed coming out. They raised rates, they paused. They may have one more hike in them. And but they're going to pause for a while, and which we'll look at. We've looked at the charts where usually they'll pause for months. So it's just compounding the issues just of credit card debt, of car loan debt, all these things just keep hitting people, right? People can't refinance at a cheaper rate, all those things. And so the pressure just builds up. Same thing for corporations and government debt, right? Government debt has to pay high interest on the debt that they on the what they borrow. So it impacts that too. As the final stretch of the year approaches, there's relief in the markets that the sharpest global monetary tightening cycle in decades is finally nearing an end. Yet strain from the interest rate hikes has just started to come through, with central banks signaling that rates will likely stay higher for longer. The notion that something breaking remains strong. So you can see the race to raise rates. The U.S. raised it by 525 basis points, which is 5.25%. Same thing with New Zealand. And you can see that, it's at about 5.5 right now. UK is right behind us. Japan, that's an exception. They've been having low interest rates for a while. Japan does have less consumer debt and such, and so the people over there live more frugal. So they have their issues unique. So the first thing is property pain. This talks about how the real estate market is pretty much going through its issues because of the higher rates. A string of German developers have tipped into insolvency. London's office market is in a rental recession as vacancies hit a 30-year high, and U.S. banks revealed spiraling losses from property in first half figures and warned of more to come. So I kind of wonder what this is about, right? Let me just bookmark that. Sweden is the hardest hit in the U.S. and in Europe, since much of its property debt is short term, making it a harbinger for the region. Let's see. Property group SBB, which owns large tracts of property, including hospitals and schools, is scrambling to repair its battered finances, marred by heavy loss and dwindling cash. And that means that the rates are higher. It's affecting the cash flows. People are strapped for cash. Businesses are strapped for cash. I actually just talked with one of the junior miner CEOs of a junior miner company, and he mentioned that the junior miners are getting killed. They're trying to find financing. They're trying to find funding to keep exploring and all these things, junior explorers. And so it's a tight market right now. So this is the European market. So these are the house prices versus the quarter. So it looks like the house prices are continuing to increase while rates are higher, cost more to borrow. Made in China property is also at the heart of China's woes. So we're seeing that the higher for longer rates are impacting many different sectors, right? I mean, you're seeing the property sales by floor area. I mean, these are just plummeting in China right now. Money problems. Corporate debt defaults have started ramping up, even in typical quiet months. So the corporate debt, we talked about that a little bit, right? The number of new corporate defaults globally reached 16 in August, the highest August tally since 2009, according to the S&P. The latest sign that corporate stress is building. So many people have said, like, when the Fed raises rates this fast, all the effects come with a lag. So some people that incorrectly called recession for 2023 are now saying, like, okay, well, it's probably going to be 2024, Q1, Q2 of 2024. We still remain to see. Obviously, you got your boy at Bank of America saying that we're going to have a soft landing. Some people saying we're going to have no landing at all. But it looks like from this article, that it's people are starting to feel the pain. There's lots of talk in the market about corporate stress and hidden leverage, but it has not erupted yet. We still think defaults are coming, said Marcus, head of fixed income of research. We have many zombie companies in the United States and Europe from the low interest rate eras, and I cannot imagine how they can survive now with high interest rates. S&P forecasts that defaults among rated European companies will reach 3.75% by June 2024. So these are the defaults, corporate defaults. In 2009, you had 25. Now in 2023, we're at 16. So this number is rising. It's above the last 13 years. And this was, right after the global financial crisis. I mean, in the midst of the global financial crisis. So as you can see, people are feeling the pain. What's up, JT? Good to see you, bro. Hope you're doing all right, man. Y'all be sure to go check out JT Coin Rings channel. Be sure to check it out. So corporations are feeling the pain, right? People think that this stuff doesn't affect anything, and we're just, I think it's just getting started, probably. The money from the COVID era is drying up. Let's say that it's drying up. Banking stress has gone down to the worry list since March. The March crisis wreaked havoc. Big U.S. banks sailed through the Federal Reserve's annual health check in June. The European Central Bank has asked banks to provide weekly liquidity data so it can carry out more frequent checks on their ability to ward off potential shocks as rates rise. Someone said banks are in a better position in terms of their capital and liquidity compared with March. Still, big question marks remain over the future, not least from global property rout. There's still inherent vulnerability to deposit flight, as well as commercial real estate and other credit exposures for smaller banks. So that's a very important point. I just had a interview with Nomi Prinz. Nomi Prinz worked in the banking sector for quite a while. She was at Chase Manhattan Bank before JP Morgan bought them out. She was at Goldman Sachs. She was at Bear Stearns and Lehman Brothers before they went down in the global financial crisis. She knows the banking system. She writes about it. She's a best-selling author. Be sure to check out that interview with her. I have it both parts up now, but she talked about how the regional banks are the ones that are still at risk. And at one point, there's an article that said, or it was some data that came out that says 722 banks were still at risk, like Silicon Valley and the others that went down in March. And this is because they bought a lot of corporate debt, or no, a lot of government debt at very low interest rates, meaning that they lost money. And in order to liquidate that, they have to take a loss because interest rates have risen significantly. So the smaller banks have these issues. JP Morgan and them, they can swallow that cost, for the most part, but these smaller banks, they struggling. And so, and then also vulnerability to deposit flight. That means that people making a run on the bank, bank runs. So it's people taking their money out and they're dipping out like, hey, we're gone. And then when the bank doesn't have liquidity, then they go under. So as well as the commercial real estate. Commercial real estate That's still looks like a big risk factor for banks. Many banks have commercial loans, so people aren't going into the office as much. Interest rates are higher. You know, especially if companies are paying for these commercial real estate buildings and people aren't showing up to work, and it's just excessive costs. All of that, right? That remains a risk for the banks. So, um, yeah. Regional banks underperform. The change in the S&P 500 regional U.S. bank index since the beginning of the year. So now it's down 40%. This is comparable to 2008, right? The global financial crisis. I mean, you saw this in 2007, 2006. It looked good. 2007, boom, 2008. So now we're seeing this as well. This is for the regional banks. Um, it's not looking good. Here we had a lot of liquidity pump 2021, all that cheap money. Y'all remember, right? Um, so yeah, that does. I don't know, y'all. This article ain't looking too good. I don't know what y'all think, but this article is not looking too good at all for the markets and such. And so, um, the Japan factor. Bank of Japan has held steady fast to ultra easy monetary policy, but a tighter stance is on the cards. The risk of a sharp unwind from an era of Japanese cash pumping into everything from U.S. tech stocks to high yielding emerging market currencies. Um, Expects the Bank of Japan to hike its policy rate in January. It notes that Japanese investors who have long sought better investment yields elsewhere around $1 trillion of U.S. bonds. They are big holders of European and Australian debt. Japanese selling of treasuries could further push up yields already at their highest since the global financial crisis. That could hurt equities, which tend to perform worse when investors expect higher returns from low risk government bonds. Um, so, as you can see here, this is Japanese holdings of foreign assets. So, it holds a lot of a little under 750 billion in U.S. equities. It holds a trillion, close to $1 trillion in U.S. debt. That means they're buying bonds. That's how much they hold. As far as in the eurozone, they're holding less than 250 billion in stocks and then 500 billion in bonds. So they've been going outside of Japan. So it's going to be interesting to see how all of this unfolds. All right. How y'all doing out there? What do y'all think about this information? Let me know. Drop a comment. What are you thinking about this information here? This information looks kind of grim to me. It looks pretty grim. Y'all think that the Fed beat inflation? Do y'all think that the high rates for longer is going to be, we're going to come out of this okay with no landing or a soft landing? What are y'all thoughts? Yeah, let me know in the comment section. All right. So, let's go ahead and we're going to jump into some stocks now, because I want to look at how we can protect ourselves, right? All right, so here we are. We're looking at the S&P 500 now. This is just index, right? We can see that it's just been on a tear all year, right? I mean, January was here, 3,800, rose all the way up past 4,500. Now it's at 4,288. So it's been on a correction. I don't know if it's technically correction. I have to look at the percentages, but it's been on a light correction, I guess. And so I think this is important because when we look at the 2-year mark, it hit pretty low October last year. Last year we went through a huge liquidity problem. S&P dropped to 3,500, 3,585. May have been lower than that. Um, but and then we bounced back, and then now we're back, headed down, and we're almost towards that October mark again. I mean, we had 1, 2 weeks, 3 weeks, it chopped sideways. Then we had another down week. Yeah, so we went down in October. So now we're looking at, it's been going down, popped up a little bit. Now it's going down again. So yeah, I mean, we could see some further downside. So I want to jump into a couple companies that I'm looking at right now that I'm actually buying. So I started buying Echo Patrol. This is a oil producing company, and they are based out of Colombia. So there's some risk there. There's some risk there. Obviously, we've seen. I mean, this the performance outlook, down in the next 2 to 6 weeks, and then up, longer term. We see that oil inventories are low, as low as since the 80s, right? We see that OPEC and Russia have cut production, right? Um, let's see. Cito said, I don't think they beat inflation. Higher for longer until something breaks, or very high rates, Volcker style. Yep, I agree. Only part I don't agree with is Volcker style. I just don't think that they are going to. Um, well, Volcker let the market raise interest rates, and he kind of left it alone. But um, the very high interest rates, my only thing with that is that I think that the government debt will get just so out of control. Um, you know, the government interest payments on the debt could get so out of control that it could really put the government in the bind. And so I don't think we'll get that high. Um, I mean, it's just right now the debt is just way too high. It's way too high, and the interest we're paying on that debt is just is unsustainable. And so, unless we're gonna, I mean, if we do get interest rates that high, then the debt's gonna balloon like crazy, because we're gonna be having to, appease everyone, and keep spending, and all this stuff, and all of this is like, this is all just to maintain what we have going on now, right? Um, um, so I don't even know what a jet debt jubilee would even look like at this at this point, unless it's like a war or something, and they just erase all the debts. But that's only if whoever wins the war. Whatever. I know that's been the case in the past. But yeah, I mean, if we were to um raise rates that high, I think that yeah, the government would just have a really hard time paying down the debt. Like, we'll be spending a whole lot, as well as paying more on interest, and so it would just be bad. Like, I think will the debt could balloon to 40 trillion before you know it. So yeah, but yeah, so Echo Patrol Oil Company, this company pays a 28.5% dividend. 28.5% dividend. So, like, that's just amazing. I mean, they just paid it out. So, I mean, if you're buying it, you got to wait until the next date, which is December 19th. But you can accumulate your shares by then. And, I was able to get in on a dividend. I'm going to get in some more on this one. Um, but yeah, 28%. That's higher than what the government's paying you. Government's paying you what, 5.5%, 5.6%. I mean, some of the savings products for banks are paying you 5%. Um, what else is out there? Inflation's at They say it's at 3%, but even ShadowStat says it's at 6-7%. So this stock here is paying you way more than the inflation rate, plus the government they would pay you, plus what your bank would pay you, you know. So, and it's at a 3.12 PE ratio. So that means the stock is cheap. Stock is cheap. So for every dollar of earnings, that represents the stock price. So pretty much, if you divide it, um, 11.58 by 3.71, the earnings, you would get this PE ratio. So that's how you get the you get this price to earnings ratio. So yeah, this is one that I just started picking up. Um, we've talked about this one on the interview I had with Rick Petrobras. This is another one, dividend payer, 24.58%. I'm just like, man, these dividend payers are just insane, right? Um, PE ratio of 3.23. The stock is way undervalued, right? So, you got to really think like, okay, like, like you're earning a lot over time. I mean, you could probably earn your money back on this stock. Um, Dang, my webcam is just tripping, y'all. Let me see if this cord is loose or something. But you can earn your money back on this stock. Like, if you're investing, I mean, you get your money back in a couple of years, 100%, right? They pay dividends out, I mean, 2-3 years, you can get all your money back, so um those are some heavy hitters, right? Here's some other ones I've been buying. I've been buying more Mosaic agricultural. I think agriculture is going to go higher. This is at a 5.56 PE ratio. It does not pay a high dividend, right? It's only 2.25%, but it's undervalued. And I think for a long-term hold, this is definitely something that's going to go higher. When you look at the last, 5 years, I mean, this stock was at, $66. Now it's, cut in half from that. And when you look at, the last commodities bull run, this stock ran up to, $150. So right now it's at $35. So this is a good one that I've been buying. I did start buying some other stocks. For example, I did start buying some Chinese stocks, JD, the Chinese Amazon. I did start buying them. Their PE ratio is a little higher right now. But I think this is a solid company. I don't know what the future looks like. It's more of a spec play. Even though I do think that um, it has a lot of potential. I mean, whenever China does turn it around, I mean, this stock was trading at $100. Now it's at $29, and it's pretty much at its low since 2018. So that's kind of like a spec play that I'm playing into because the other stocks, I mean, they're still kind of up right now. I mean, when you look at Alibaba's at $86, Baidu 134. JD was up there with these stocks, and JD's just been getting clobbered. So yeah, but yeah, I've been kind of in and out of JD for a while. So that's one I've been picking up. That's not a commodities company, but just wanted to throw y'all something out there. Newmont Mining started getting clobbered again. The gold miners are just getting decimated. I started picking up more Newmont. They only pay a 4.29% interest rate. I mean, not interest rate, dividend. Um, and they're just getting clobbered. The miners are just getting clobbered. And so this is, uh, I don't think this is necessarily overvalued, but um, gold is like one of the commodities that's very, very bearish right now. Very, very bearish. Gold stocks are just very bearish right now. People do not, they're one of the hated assets. Gold and coal stocks, coal. So those are two commodities that are just getting no love. Uh, they're they're getting no love. I mean, people are buying the physical metal. I mean, there was a recent video we'll watch in a minute with Costco selling out of their gold 1 ounce gold bars. So um, people are buying the metals, but these gold equities are just getting clobbered. I mean, look at this in the last, this is just in the last month. I mean, it's at $52 now. It's at 36. Last month, it's just man. This is all of them getting plummeted like this. I even I buy Sandstorm. Um, this is a gold royalty company. They're at, you know, the last month. I mean, they're down quite a bit, but they've kind of been, plummeted for a while, but they were at $6, now they're down. So yeah, I mean the gold stocks are getting hit. Um, I mean Franco Nevada's at 133 right now. I should have kept them. They had dropped down to like I had bought Franco Nevada right here. No, 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 not right there. I bought them. Where was it at? It was right here. They were at 107. I should have kept them. Spiked up to 159. This is a solid company. So yeah, there's a lot of opportunity out there. There's a lot of stocks that are very cheap. I mean, if you're still, looking at the Nvidias and the Metas, I mean, if you go to Meta, right? I mean, 300 a share. Um, it's still pretty high, right? It's like, look, it's been on a tear this whole time, from $124 to $300. I'm not touching that, you know. I mean, it's still up there. So I was buying Meta down here too. I wish I would have kept them. But yeah. So I mean, if you're looking at companies like that, I mean, I'm cool on them. Let's see what Apple's looking like. Apple's at 171. Yeah. Apple's just continuing steady climbing. Like it's just not coming down. I mean, it went up to 196 this year. Now it's down to 171. That's not a big enough correction for me. I mean, maybe, where did it pop down to last year? Last year it was 138, 129, December. Yeah, I'm not touching it. I am not touching it. Let's see, Nvidia. Nvidia still, these are the magnificent seven we're looking at. Nvidia just been on a tear since, September last year. Boom, 493. Now it's down to 4. I'm just not touching this. 104 PE ratio. 104 PE ratio. All right. So I'm gonna show y'all this just to just show y'all really quick. 104 PE ratio. It's terrible. All right, so we got 434. Let's see. I gotta check out something really quick. Dun-dun-dun. Yep, exactly. All right. So when you're looking at the PE ratio, price to earnings, you're looking at the price of the stock, 434.99 divided by the earnings of the stock, 4.17. So $4.17 per share. That's the earnings. So 4.17. And you get that 104.31 PE ratio. So for every dollar of earnings, you're paying $100, $104 for every dollar of earnings. That's way too expensive. Way too expensive. Rusty LM, I'm all about energy. Agree. I'm right there with you. Which tankers are you looking at? Which drillers are you looking at? I've honestly been looking at companies in other countries, like that people in the US aren't as uh they don't know about as much. I mean, obviously you may want some bigger caps and just to diversify risk, but um yeah, I'm looking at companies at other spots. I mean, my guy Ben, he just put out a video on the BW Energy. It's a offshore drilling stock company, and but they trade on the Norwegian stock exchange. So I'm probably gonna go buy some of them. If y'all haven't watched my video on how to buy companies on the other stock exchanges, be sure to check out that out on Interactive Brokers and how you can access these companies. And these are the companies that, if you want to buy stuff, like your friends aren't going to be talking about these stocks. Like your friends, you're going to, if you're talking to your friends, they aren't going to be like, oh yeah, I bought on the, Norway Stock Exchange and stuff. Like they're not going to be talking about it. So it's like some of those companies that you can get in early, and and just hoard. You know what I mean? Appreciate you, Rusty. Appreciate that. Definitely, oil, gas, drillers, tankers, and nuclear. I'm all in there. Those are that's where I'm at. That's what's cheap. We're not looking at these companies with these 104 PE ratios. That's just not what it's about. I want to look at something real quick. I want to do Newmont's PE ratio really quick. I'm gonna see if I can get it. All right, so on Yahoo Finance is saying that it's the stock price 36.95 divided by the earnings, which is 0.98. No, that's wrong. I think it's clear. It's negative 0.98. Let me find a dang negative. Dang, I don't even know how to do this. Minus. Let's do minus 0.98. Maybe that'll work. So negative 37 PE ratio. I don't know if that's good or bad, but that's what it is. So Newmont Mining, obviously gold company, and the miners are just getting no love. They're just like, the price of gold is very elevated. I mean, it's still elevated. It's at 1,800, but the miners just aren't getting any love. Price of gold, I mean, it's been on a decline. It's at 1,864 right now. I mean, the last 6 months, I mean, it was at 2,000 back in May. It's 1,848, and the miners have just been getting clobbered. So Yeah, it's hard. It's a hated asset, but I think that these got a lot of potential. So I'm still buying gold shares. Okay, Rusty gave us a couple stock picks. I'm actually in DHT. We're both in there. DHT, that's another solid one. DHT Holdings, um, PE ratio $10 per earnings of shares, earnings per share, and they pay a 9.93, pretty much a 10% dividend. So, yeah, this is a solid company. Yeah, you have to export energy. And then you said you're in Frontline, right? It's Frontline. Is that what you said? Let me see. Yep, Frontline Tankers. Let's go to Frontline. Frontline pays a 13% dividend. It's pretty nice. PE ratio, 4.96. It's not too bad. Let's see. Frontline has ran from June. I mean, it's been running up, but it's still, a decent valuation. And I mean, shoot, even Yahoo Finance saying that they're undervalued. I was buying this company back early on too. I didn't really understand the tanker market though. I'm starting to understand it a little more, but I need to do some more research on it. But yeah, this one looks like a pretty good, solid company. The PE ratio with the earnings to get decent earnings. Market cap isn't too big, so there's room to grow even more from here. $18 a share, 13% dividend. We missed that ex-dividend date, but they will be back 3 months. So that's pretty good. Appreciate that those tips out there. All right, so you position. Okay, I see those position in front line. Why y'all just now telling me this? Rusty said YPF out of Argentina owns over half of the largest shale field in the world. It's a risk. Anything in Argentina, but that country no other option than to drill and export and get some cash. Face blue wide eyes. Yeah. Where's YPF? Let's see. Didn't they get a new president, libertarian president? That's what I was thinking, right? I mean, they have a low PE ratio for 10 billion. Shoot, I may have to. I don't know, Rusty. You may have gave me a plug. I may have to snag some of them. I mean, they've been around for a while. I mean, let's look at this last bull run, 2002. $10, what they go to? $68. Okay, so it's a good run. And they just been getting clobbered since then. Okay. So there's some potential there, undervalued. I gotta put them on my list. YPF. Jurisdictional risks, but there's risk in everything. And then Sting. Cito says Sting. I hope I'm saying your name right. Scorpio Tankers. 3.81 PE ratio. 1.84% dividend. It's not paying as much as the competitors, but you're probably getting more growth out of it, depending on how they're investing back into the markets, investing back into their business. It's ran from $12.81 to hit up 60.54. sometimes I don't even like looking at these charts because these charts just like sometimes they show the dilution. But yeah, I mean it's undervalued. It's just a little more on the expensive side. So I mean, you got to put a little more capital in to get a good amount of shares with them, um, for sure. But I mean, if you got capital, I mean, you can. But otherwise, you could get 5 shares of DHT at 10% dividend for 1 share of Scorpio. Um, same thing with Frontline. You probably get 2 shares at Frontline. 2.5 shares. So got it. I usually use TradingView. I used to for a while, but sometimes it's hard for me. I have to do a whole tutorial on it again. It would like the chart would get messed up and stuff. Like I'm just not proficient at it. I have to like practice with it a lot more. And honestly, I don't look at charts a whole lot because I'm just more of a long term investor. I'll look at charts like if I'm looking at past performance and okay, like okay, how did it do in the last commodities bull run or things like that. Um, um, so yeah, so I haven't been much into the charts lately, but I have been in before. Um, Halliburton, Schlumberger. So I'm actually doing a stock analysis on Schlumberger. That's gonna be one of the companies we're gonna do one. I mean, because they do like it's like tech company and um, energy, and we're also gonna do one on what is it? Decker, and what is it? Swap. How did I say it? Decker, SWK. So Decker and DeWalt. So we're gonna do one on them too. They actually produce the picks and shovels and the tractors and all of that stuff for oil companies. So I'm looking at them. So all the country stocks are in the flux from the uncertainty with the election coming up. Yeah, so yeah, it's gonna be interesting. So my guy Benjamin, he's actually moving to Argentina in April of next year from Australia. So it's gonna be pretty cool. So yeah, it's gonna be interesting. So I'm gonna look at we're gonna look at Schlumberger real quick. Y'all give me some ideas of what I need to pick up. I need to take some notes really quick. Um, obviously Frontline is one, and then the YPF. Those two are on my radar. So I'm gonna put a note in for those. So I want to look at Schlumberger real quick. SLB, $58. And sometimes I struggle with this because I was buying them at $35 and they just shot up, and I sold for the profit. And now it's like, okay, do I want to get back in there? I think I was buying them around here, $30, and it shot up. I mean, it would probably been best to get them at that pullback in May, but they're at a 22% or 22 PE ratio, 1.64% dividend. I mean, they still got potential. I mean, they can run, could definitely run. I mean, they ran up to what 101 the last bull run. Oil was booming. 109 pop dropped. Global financial crisis. I mean, shoot, if you could only just time these tops, be like, okay, I'm selling out right here, and then when it drops, okay, the drop, I'm gonna buy back in. I'm just saying this like we're some like grand wizard or something. Like we can just see all this coming, right? But yeah, so yeah, so I mean, they're I think that they have potential to run even more. It's kind of higher on the valuation side. the PE ratio side. I have to look at like the assets and things like that, the balance sheets. Um, so yeah, I have to look at that. But yeah, all right, y'all. Appreciate y'all engaging, sharing some stock companies that I'm gonna actually look into as well and everything. I hope y'all have a good night. Be sure to go check out the interview I recently did with Naomi Prince. It's amazing. She's an amazing author, a lot of experience and such. And so be sure to go check that out. I will probably be back on tomorrow or something. So hope to see y'all, engage with y'all again. Y'all take care and y'all have a blessed night. All right. Peace.